Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main immediate pattern here since September 2024 had been, and still is I suppose after a fashion, the breach and now seemingly repaired dark blue September to December 2024 bear channel. That's currently 1730 to 2017. This pattern achieved its primary downside target in mid-January and its secondary hard to reach target about a week after the primary target. Interestingly, the move down to the secondary target and back up again formed another new pattern, one which I will discuss shortly. However, before that, I'd like to highlight again another larger long-term pattern, and that is the bright green breached but seemingly moving to be repaired November 23 to September 24 bearish Andrews pitchfork. This pattern, as I said, had been breached but is undergoing surgery right now to be repaired as it dropped down back below the breached bright green upper time, currently at 1918 late last week. However, I was, and I still am, considering finessing this into a shallower bearish shift pitchfork and maybe even at some point retiring it completely. I have another pattern which I would like to discuss and maybe another to think about. The pattern to discuss is the bright pink late September 24 to mid-January 25 bearish Andrews pitchfork, which I drew 4 weeks ago to try and help make some sense of the recent moves. We are today still in between the middle time below, currently at 1792, and the upper time above, currently at 2048. Elsewhere, during last week, we dropped below the green short medium moving average, currently at 1937, which is now resistance, which had been reinforcing the bright green upper time. We are today testing on the downside the February 2021 high at 1894. And a little further below, we have two interesting 50% Fibonacci lines. The first is the nearer April 20 to November 23 move at 1859. Then the very interesting 21st century 50% absolute Fibonacci line at 1809. Okay, so all this no longer leaves us with the possibility to think about looking at the mid-January to early March action as a bullish Andrews pitchfork, but the door is still open for a shallower bullish shift pitchfork. However, at least for the last 3 weeks, I haven't done much more than contemplate this as an idea, as it has all the issues of being part of a continuous daily chart and clogging up my daily chart with even more lines than I already possess. However, it remains, how did I put it before? It remains on my radar. To counter this, I'll reprise part of my commentary from 3 weeks ago when I said, and I quote, "So in an effort to get a handle on what further technicals were operating here, I went back to my annual commentary last week. I looked at the monthly charts there, and I saw that the bright green Andrews pitchfork, despite the breached topside, is still the dominating pattern, along with a double top, an Adam and Eve type, that had been constructed throughout 2023, and which had already reached the primary target 1880, leaving live, still as yet unfulfilled, harder to reach secondary target, down at 1630. This longer term pattern is the one I choose to watch, and I'll see how it develops." End of quote. Well, I'll maintain that point of view. Ice Europe white sugar in London. There continues to be 3 features to bear in mind here on this daily chart. The first is the obvious purple late September to date descending expanding wedge pattern. This pattern has more than the requisite 5 touches and was severely tested on the top side over late February through into the start of March, when prices dipped down below back within the pattern. However, 3 weeks ago the market pushed up over the purple upper trend line and even gapped higher 2 weeks ago, threatening and briefly breaching the high made back in late February, the February 2017 high at 565. However, the market has not stabilized over this February 2017 high as yet, closing only once on it and never over it. We've since dropped back down last week and today just back within the breached and possibly repaired once again purple descending expanding wedge pattern, though we are back up again above it and above the gold long moving average. The second is the January 2024 to date downtrend, currently at 563 even, highlighted in bright red above the market on my daily chart. It had effectively capped earlier rises since its start, most recently late February, but 2 weeks ago was breached, enough that last week I chose to realign it to include the highs of 2 weeks ago. The third is the previously mentioned flatlining gold long moving average, currently at 541.30. This had previously helped cap prices, but we saw a gapping push up over it 2 weeks ago. I said 2 weeks ago about the gold long moving average, and I quote, "Unless the market turns down rapidly, then this will pare down its importance," end of quote. Well, we have seen that turn down and a gap being filled in last week, but now we're seeing the market turn back up over it. Okay, so I'll now like to run through some newer features I discussed last week and a potential pattern that I introduced 2 weeks ago. Unfortunately, some of these patterns are on the verge of being retired already. The first feature was to lay out some potentials for a move up and out of the purple descending wedge pattern. I said 2 weeks ago that, and I quote, "These may be a bit premature, but I'd rather lay these out now than later," end of quote. Thus, the primary topside target X is in the 650.10 area, with a secondary harder to reach target X1 up in the 673.80 area. Excuse me. This week these are quite a way away, and I'm now starting to have thoughts about retiring them, though this may be a little bit premature given today's action. Next is the view that the whole late January today action as a possible bullish half hesitation. I added 2 weeks ago, and I quote, "If this becomes the case, and we will have to see how prices perform over the February 2017 high, then we can start viewing the primary target X2 up in the 605 area," end of quote. Well, since then, especially considering today's actions, I'm on the verge once again of thinking about retiring this idea completely, but with today's move, tempering that. Added to this has been last week's move below the final and only bullish pattern I've drawn on my daily chart, the bright green mid-January to early March bullish Andrews pitch walk. And that's actually a shallower bullish shift pitch walk may not work for this move, but I will retire the bullish Andrews pitch walk by next week. This has left us with potential for a new pattern, a choice of two possibilities. A mid-January today bullish half hesitation, or, and it is an or a possible double top for the same move. I have to say right now, I'd been sliding towards a double top idea, though we have seen we would need to see a drop down and break of the September 2022 low at 517.80 and the October 22 low of 514.5 to achieve this, as well as punching through some congestion from late December last year through to January this year in the same region, as well as the congestion from early 2017 in the same zone. I should actually note this is where the early March low occurred, and I'm very interested to see how today's action, whether it will manage to do anything about that March 2017 high. Sugar white premium spread. A hammer pattern last week, a pattern usually seen as bullish. This after the previous week's shooting star pattern, type 1 bearish. Below we still have the support of the gold 1 year moving average, currently at 109.25, though this hasn't been tested since the middle of March. However, what we have seen over recent weeks is not just the reluctance to push below the gold 1 year moving average, but also the reluctance to test up towards the significant combined 50% Fibonacci lines overhead of the July 19 to September 22 move at 128.75 and the August 21 to September 22 move up at 131.25, plus the June 2020 high at 134.25. Nevertheless, overall we can still view the action over recent weeks as a continuation of the break up and out of what was originally a descending wedge pattern that developed into a big bear channel from April 24 to the end of January 25. We have now been hesitating for 5 weeks between 111.75 to 127 even on the wide. Is this enough to start talking about a possible bullish half hesitation from the start of the year or else a topping action? At the moment I'd favour the idea of a possible bullish half hesitation, but it's still very early as an idea. Hence I've once again decided to leave the potentials from the original large descending wedge pattern seen throughout 2024, still on my daily chart of a primary target X up in the 137.5, which is above the immediate overhead resistances, and a secondary harder to reach target X1 up in the 154.5 area. So these So, are these targets achievable? Well, yes, but there's a very large question mark hovering over all of this due to the overhead combination of the previously mentioned 50% Fibonacci lines, plus the June 2020 high, and a congestion area we have overhead between 128.75 all the way up to 153 even, which will make target X perhaps hard and target X1 further up just that much more difficult. Today, well, it offers no definitive clues. And as I said 3 weeks ago, and I quote, the market has not taken the bullish incentive by the horns. Sorry for the mixed metaphor there. We have not pushed just that far enough as yet. End of quote. I also pointed out 3 weeks ago, and I quote, apart from the gold long moving average, we really don't have that much below until we start approaching the 85 even zone. End of quote.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.